Well, a very warm welcome. Thank you for joining me. Just a quick disclaimer, this video is intended for educational purposes only. And we have our summary since November 8th, 2021 for you new viewers. The reason why we have a start date here for this summary comparison at November 8th is that the Federal Open Market Committee announced on November 3rd that they would be ending quantitative easing and then subsequently would begin to raise rates. And that announcement came on November 3rd and was first implemented on November 8th, hence our start date of November 8th. So that out of the way, we can see the changes in the equity markets, at least in the top tier, the S&P 500 and the Dow, have not been very significant. We've got a 1.5% pullback in the S&P since November 8th, about a 3% drop in the Dow. Not a very severe pullback in those two markets, but what we have seen is a little bloodbath in the bond markets. The shorter the term, the shorter the duration, the worse it's been on a percentage basis, with LIBOR hitting 1%, two-year Treasury yields closing at 2.35%, and those represent nearly a 600 and 475% increase from the lows. So they have been some very serious increases. Today's 5-year Treasury yield closed at 2.485%, and we can see going down the list the 10-year Treasury yield at 2.4%. And a couple things of note, we do have a slight inversion between the 5-year Treasury and the 10-year Treasury note, and then we are very close to having an inversion on the 2/10 yield curve. And that inversion is, or that differential, excuse me, right now is at 0.51%. It's very close to inverting, and we do expect that to invert in the next couple of weeks, and we will show you why over the next 3 slides. Well, maybe 4 slides. Here we go. On the 3-month LIBOR, we can see it at 1%, and it does look like the meteoric rise that we've seen since the beginning of March has tapered and is beginning to level off. And we see the 2-year chart on the 2-year Treasury yield at 2.33%, and the 5-year Treasury yield again at 2.4%. And let's get to the 10-year, because that's going to be the story of the day. Yesterday we had a chart, a projection chart, and that's the next one we have up so you can see it again. But we had a projection chart going back last September where we had projected a yield of 2.495%, effectively 2.5%. Yesterday's high intraday was at 2.503%. So we basically hit it spot on. And what we're looking for now, and what we are seeing actually, and the reason why this is rather interesting, is that we did see a pullback today, a rather sizable pullback. Closed today at 2.4%, closed down 7.7 bips from yesterday's close. That's a pretty significant pullback. And we can see the initial target at 2.495% that we had put out. That was on a client call last September, on September 23rd. Now that we've hit that target, where do we expect to go from here? What type of pullback we have, we'll go to the next chart. Here we are. And what I did is just took a look at what's a reasonable target range that we might hit. So we laid out some Fibonacci ratios, looking at the lows for the month to the highs, and that 2.2% rate, and basically another 20 points lower on the 10-year Treasury yield. That seems that just has the right feel to it. It might go a little bit lower than that. You could see it going back to the previous highs at 2.06%. The Fibonacci ratio there is a 50% Fibonacci retracement at 2.09%. But that would seem to be the range that we should pull back to, somewhere between 2.2% and say 2.1% would be a reasonable spot for us to pull back. If we do so, that's where we're going to get our yield curve inversion with the 2/10s, because we're not going to get that big of a pullback in the 2-year notes. So that's where we'll get the inversion. And we have our 30-year Treasury yields. We can see where we've got a reversal on those as well today. And then finally, looking today at the 30-year fixed mortgages, pulling back just a tad from yesterday, and we're settling in at 4.875%. So there we are. We are expecting to see at least a little bit of short-term relief in rates, and we'll see what happens. Thank you very much for joining me. Have a wonderful day, and we'll see you again tomorrow.